Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to another week of The Wealth Flow. And today we've got on our podcast, Mr. Dan Calonge. Dan? Well,
how you doing, Pete?
Pretty good, man. Pretty good. How you doing?
Doing well, thanks. Glad to be here today.
Yeah, appreciate it. Dan is in the multifamily space and really, I would say relatively new, very experienced, but relatively new in the multifamily space. Over the last year and a half, Dan has gone from 0 units to 609 units that he is a part of. So want to talk, Dan, a little bit about that and dive into what you currently have going on. But why don't we start really from the beginning? Tell us a little bit about yourself, a little bit about your background.
Yeah, sure thing. Before I dive into that, I just want to say that I'm real excited to be on your podcast. I've enjoyed getting to know you over the years, and this is exciting. So,
absolutely. Thanks, Dan.
So
appreciate it.
My background is a little bit unique. My family is from Cuba originally. They left Cuba in 1960 when Fidel Castro took over, and they fled the country, then came to the U.S., and then I was the first born in the U.S. And for me, it was, I've had a pretty much American childhood growing up, but stayed very close to my roots, and I speak fluent Spanish, and with my family always very close, and for me that storyline has made a big impact on me. I always think that I can't believe how blessed I am to be in the situation that I'm in, that I live in this country and I'm able to do what I want to do, and be able to be successful on my terms. And that's something that can't be taken lightly. And you don't realize you have that until you see people that don't. So it's pretty cool. That's really the beginning of my story. And then, moving on from there.
Yeah, really. Before you do move on, I would just say, it is quite amazing when you hear, at least being able to recognize that what a gift it truly is. I think, unfortunately, oftentimes, especially for folks like myself who were born in the United States, obviously, me a little bit, to know that my wife is Colombian, and so I kind of see both sides of that perspective. She was not born here in the U.S., and it's inspiring for me to see folks that have not been born here, just to see what they go after that opportunity. It seems like sometimes better than those folks that were born here. So,
yeah, Keith, that's a great point. I mean, in my case, I still have family in Cuba and talk to them on occasion, and just the situation there is pretty bad, and not only just with food and water, but also just freedoms in general. So to be able to do, in this great country, I mean, it's an incredible country. I'm so blessed to be an American and being born here and now being raised here and now as an adult, it's just a amazing place. And I wish more people could see that when they get to know sort of what else is out there. I think it becomes a lot more real.
Yeah, makes sense.
No,
that's a great point. All right, and then just a little bit more on your background. Yeah. Where all you've lived. I know now you're currently in Kentucky, but tell us a little bit about where all you've lived.
Yeah, so my career has been pretty interesting. I've lived in probably 8 different cities in the last in my life. I'm currently in Lexington, Kentucky, which is on the center of the state, but I've lived in Miami, Florida, in Seattle, Washington, Austin, Texas, Ann Arbor, Michigan, a bunch of different cities, and really professionally, really is what drove it. I had different career, different jobs, different places. I'm in technology, so I worked for a number of large technology companies around the country, and been in that for about 28 years. And so I've really been moving based on jobs that have come up and opportunities that have come up. And I've really enjoyed getting to know new places and new people. And for me, that's a lot of fun.
Yeah, that's neat. Okay. And as far as real estate, what got you into real estate?
Yeah, it's a great question. It's something I've always been thinking about. I read Rich Dad, Poor Dad back in the early 2000s. And I had always thought about that whole narrative of the book, and it's always been in my mind about real estate, getting into real estate, but never really put pen to paper, so to speak, until the pandemic hit. And like many of us in this country, that sort of changed a lot of things for us. I was working up until that point in an office at a technology company based in Cincinnati, Ohio. And we were all sent home on March 17th, I think it was. And then we were working from home, and we couldn't go out, we couldn't socialize, we couldn't do anything. And I had some time on my hands, and I thought, this is it. I'm going to start looking into this real estate thing, because I think there's a lot of potential here. I know there's a lot of people that have done very, very well with real estate, and I just wanted to know more about it and see if I could get started. And that really started my journey back in March of 2020, and that's what progressed until today. I'm very active in real estate, but it all started from that one moment. And I often think, would it have worked out that way if COVID never happened? I don't know, but it was certainly kind of the impetus for me to start thinking and start learning, and then start taking action to get into that, to getting into real estate.
Yeah, I think COVID did that for a number of people. Just it maybe not getting them into real estate, but just either whether it be working from the house. I mean, it just gave everybody a different perspective of things. So, I think that was
I mean, and I'll for
positive
example, it's pretty incredible what's happened to a lot of people. And, for me, I started looking into real estate, and, like a lot of people, I thought, well, to get into real estate, I guess I just need to buy a house and rent it out. And that was my thought initially. But one of the things I did to make sure that I educated myself well is I just didn't read books. I just didn't listen to podcasts. I also connected with real people that were real investors in real estate. And that really made a huge difference, because once I connected with folks that were already in the industry, I started to learn much, much faster. And pretty quickly, I discarded the idea of single family rentals. Not that there's anything wrong with it. I think it's a great option for people. But, you're going to make, in the best case, maybe a few $100s profit a month, hopefully. And, one water heater burst or one whatever, and that profit for that year is gone. And, I thought, this is not really something that's going to do a whole lot for my financial well-being. So I jumped straight into multifamily, which multifamily is, I think, defined as 5 or more units in a property. And that's really what really took off for me. And once I got a taste of it, I was like, oh, wow, yeah, this is definitely a different ballgame. And I really went all in on it, about 2 years ago.
Okay. Yeah. Great. Yeah, I can vouch for the rental property piece. I have had single families, I've had small multifamily, and you're absolutely right. You have one issue, or have one tenant that moves out that left the place in disrepair. All of a sudden, your proceeds for that year are gone, and so that is one of the magics of multifamily. Just the ability to scale, and multiply everything, whether it be the profits amongst multiple units. So,
yeah, that's exactly right. And your profit per unit now, instead of $300 for the one unit, it's 300 times 100 units. That's a very different number we're talking about. And what I love about large multifamily, which is what I focus on, which is typically 100 units or more in a property, is that given the scale, you can afford to hire professional property managers that come on site and they run the property. That's what they do. That's their career. And they do a very good job of it. And you're not on the hook for getting those late night calls or, hey, my plumbing's not working, whatever. It's being covered because you were able to afford to hire a team and still have a great return at the end of the day. So there's just a lot of benefits to that model that I really like for me personally and for investors. It's a great model to be involved with.
Yeah, I like that too. And, there's a learning curve just in doing any of this, right? But you didn't have to learn everything there is to know about property manager because you have the ability to hire those folks.
Yep.
I think that's a huge benefit. You can really focus on the acquisition and managing the asset and allow them to really fill your units and increase the rents. You mentioned 100 units, Dan. Tell us a little bit about what makes up your 609 units. How many apartment complexes are you currently partnered on, and where geographically are those located?
Yeah, so great question. So I've been trying to focus mostly on areas with a lot of growth in terms of population, in terms of jobs. And there are a number of areas around the country that have those kinds of characteristics. For me, I've been focusing more in the Southeast, which tends to be, including Texas and the Southeast, really are areas where there's just a lot of growth, period. The investments that I'm a part of right now are across 4 different properties. My first one was in Mobile, Alabama. Second one's in Jacksonville, Florida. My third was in Fort Worth, Texas. And my most recent one was in Atlanta, Georgia. All cities, so with varying sizes, demographics, that all have growth ahead of them and a lot of opportunity in the future for them to be able to grow and potentially, hopefully have more and more people that want to rent and be able to make that a great investment. Especially now with the way interest rates are, it's very difficult now to buy a home and be able to afford the payments. So, many Americans are renting, and I think there's a lot to be said for the future of rentals in this country, based on the cost of housing always going up. That for more and more people, rentals are really the solution. I frankly lived in rentals most of my life. It wasn't until I want to say maybe 5 years ago that I actually bought my own home. And the reason for me was because I kept moving around different cities. And I just thought that if I'm going to buy a home, I have to be there for at least, a few years for it to make it worthwhile. So I ended up, renting most of my life. And for many people, I think that's a very common thing for them to rent, pretty much their entire lifetime. So I think there's definitely a lot of headwinds, or a lot of tailwinds, that I think is going to be really playing out over the next 5, 10, 15 years. Even after kind of what's going on in the economy right now, I think the long-term vision of this is really good.
Yeah, there really is. There's a shortage of housing, and there's definitely a need for it. And I think you're right with the current interest rate environment, buying is just, price of houses has not come down as much as the increase in interest rate has increased the payment. So, for an average price house now, you're spending significantly more per month, and, rents really have not kept up with that. So it's still a great, affordable option.
Yeah,
I think that's good.
Exactly right.
What about, so maybe taking each of those, or maybe the strategy is the exact same on all of them, but just curious as to, obviously part of what you're looking to do, both for yourself, for your investors, is, to build value and, increase the value on the asset, increase the cash flows from where they currently are. So what were some of the game plans when it came to these particular assets? And you can either take them, individually, or just if they all fit within a general bucket. What's the strategy?
It's a great, it's a great question, Keith. I mean, the strategy in general is very similar, but each property has its own unique strategy based on the situation of that property. The investments that I've been a part of so far, we've really strategized on, is this a property where we can add a lot of value? If there's not an opportunity to do that, then it's a little tougher to be able to make the returns that I'm hoping that are going to come out of it. So things like, a very simple one is renovations. You have the property in Jacksonville, for example. It's called Tree Hill Apartments. It's a very nice property, just kind of old and not, just kind of outdated. The interiors are outdated, and now our team is working through and really renovating the vast majority of the units. Not only is that a nicer experience, a nicer place to live after it's done, but also we're able to charge a little more for that and be able to increase the value of the property substantially just by being able to do that. We improved the grounds, we redid the pool. It just makes it a nicer place to live, and in turn, it makes people want to live there, which makes us be able to make up that in terms of increased revenue coming in terms of rents. So that's the strategy for that particular one, but they all are some sort of a value add play. The most recent deal that I was a part of here in Atlanta, Georgia, is a bunch of townhomes, which is fantastic because people love townhomes. It has a home feel, but it's not a home. It's part of a master plan community, but people feel like they're in a home, which is super attractive. So that's something that we loved about 2 or 3 bedroom place is ideal for a small family. And with the townhome, you've got kind of a yard and that. So there's a lot of really great things about that property that we're really excited about digging into now. So every property's got its own story, its own plan. But overall, I do tend to focus on properties where there is an opportunity to make some sort of a big improvement to the property to make it much nicer, nice better place to live. And I like to tie this also to my immigrant background. It turns out that a lot of the folks that live in these kinds of properties that I'm investing in are also immigrants as well. And so it feels nice to be able to buy a property and then to improve it, to renovate it, to make it so that it's just a nicer place to live. And it feels good to be able to improve some, a living conditions of somebody that lives in the area that could potentially be, an immigrant family like my family was when they got here. So it's pretty cool. Something that I really enjoyed, not just the financial part of it, but also the part of feeling like I'm giving back to the community in a different way than I would have otherwise. And it's pretty cool.
Yeah, that is neat. It's definitely rewarding to be able to provide some kind of affordable housing. People in general, whether it be on the United States or anywhere I've traveled, they're all generally about the same, right? Everybody wants to live in a nice, safe place, the place to be kept up well, and so there's real opportunity out there for a lot of those places that maybe weren't managed the best, that just need a little bit of a facelift. And obviously from an investing standpoint, if somebody that is actively out there in the rental market, they, a lot of times they're going to be searching online. A lot of times they're going to be stopping in at different locations. And if the inside is dated, it's not going to show as well, right? As been updated, that's new, that's freshly painted, so all of these are opportunities to really kind of bring it up to speed, so that it becomes attractive and it can compare even with newer facilities and newer apartments. So that's a great strategy for sure.
Yeah, we're hoping it's going to work out well, but I mean, so far it's been great. So that's the plan, and we'll see. It's right now it's going really well, and I expect it to continue to go well. So,
and I don't know how many of the rents, but tell me a little bit about that if you can. Have you made any initial rent increases, or are you basically in the rehab stage for certain units to bring them back online, or what? Kind of where are you with your various apartment complexes?
Yeah, so the very first property that I was a part of was in Mobile, Alabama, and that one, there's definitely some renovations going on there, and the renovated units are commanding a higher rent. That's really across the board. All the properties that where we do interior renovations to units, typically they do attract a higher rent, and it's really just because you just make it a nicer place. I mean, people want to live in a nicer, modern place. It's just all of us do. So it's something that we're is definitely happening, and we adjust the rents based on the market conditions. So it's not like we just increase the rents a ton and then that's it. I mean, it's really based on what's going on in the market in that particular city, in that particular area, that particular neighborhood. There's a lot of factors. Real estate is a very local thing. Real estate can be, really hot in one area and really cold in another, which is where I always tell people to take these national stats about real estate with a grain of salt, because, maybe across the country there's this trend, but you'll see many examples where you see the opposite of that trend in certain spots, and other examples where it's that trend times 10. And so it's really, there's a lot of variability, and so we try to really stay attuned to the market in that local area, make sure that we're priced appropriately.
Yeah, I think that's smart. And, really focusing on the areas that you've talked about, where you do have that increased population. There's a lot of growth. There's a lot of people moving to the areas. Florida in particular is hot right now. Yeah, and so is Alabama. That's great.
Texas is crazy.
Yeah, Texas is nuts. Right?
Yeah.
Yep, for sure. So, with these apartments, when I think apartments, especially 100 units plus, I think, gee, how can I get involved in something like that, right? You got to have a ton of money. Tell me a little bit about what kind of purchase prices are we talking about here, and how much in renovations, that kind of thing. Just give us it doesn't have to be on all of them, but just kind of a general scope for the audience.
Yeah, it's a great question. So I'll give you an example. The last property the last investment that I was part of right now is in Atlanta, 122 townhomes, and the purchase price on that was $18.2 million. Now, I don't have $18.2 million sitting in my bank account, and not many people do. So, which is one of the things that I think is a misconception about how to get into this. Before I started really getting into real estate, I never really gave much thought to who owned these apartment complexes and communities. I just thought it must be some big bank or some big private equity firm, and that's it. It turns out that more than not, it's typically a collection of investors that pool their money together to purchase property like this. So, for example, this one in Atlanta I just mentioned, we had to raise millions of dollars, but not $18 million. We had to raise much less because we used a loan for the rest of the money. And the money that we raised didn't come from one person. It came from tens of people, if not, I forget exactly the number, but it's over 100 investors that were involved in getting and pooling their money, anywhere from $50,000 to $100,000 each. And you pull that money together, and that turns into your down payment. And those are the investors then that ride along with you during those years as you make renovations, make improvements to the property, get the value of the property up, so that when you go to sell it later, the value is substantially higher, and you pay those investors out, plus the returns that they get. And what you can actually earn from this kind of a model is incredible, especially if you continue to reinvest your money in this way over years, even decades. It can make substantial difference in your net worth over the long haul. And so I think it's just a great model especially for somebody that's a busy professional. I'm fairly busy myself. I've got I work at a technology company. So, for me, I have a day job, but this really is one of those things where you can, as a passive investor, you can put money into one of these deals and not be the one actually managing it or running it or making the decisions for it, and letting a team of experts do that. And so that turns into something that you get a lot of benefits from without having to put much work at all as a potential passive investor, which is fantastic for a busy person that doesn't have time for all that. I decided to be a bit more active with my money, which is why I've been kind of leading some of these investments that I've been talking about. But you don't have to do that as an investor. You can just write a check, be part of one of these great projects, and then have it perform for you, and you get the benefits. You get the tax depreciation benefits that you get. All that comes to you without having to be the person leading the job or answering the phone calls or anything. You just you're an investor in the deal, which is something I had no clue about when I first got into this. And to me, it just makes a lot of sense for folks that want to get into real estate, that are concerned about their time and all that. It's just a great way.
Yeah, Dan, let's maybe talk a little bit about that as well, as far as the different ways that you can be part of an investment, right? So I know you're a general partner, meaning that you're got your hands somewhat dirty on a daily basis with this, and really responsible for a lot of the operational piece. But your investors are limited partners. So there's some benefits, limited in the sense of liability as well. Is that correct?
Yeah.
Yeah. So
yeah, that's right. Yeah.
So you can take the risk on finding the deal. They don't need to learn anything other than obviously you're going to have your information slideshow and investing deck that they can look through to see what is this project, what is the game plan with it. But really, aside from just looking at it from that perspective, it's just a matter of making an investment, just like you would do with stocks, right?
Yeah, that's right. That's right. The big thing in terms of what's important with this as a passive investor is making sure you're picking a good operator. And so because that individual is really the one that's going to make that business plan work. And so that's always important to make sure that you get to know the person you're investing with, the team, what's the business plan for the property, what kind of experience does that team have? Because that really does play a big part into how well this is going to do, in the long term for you. But yeah, you don't have to, as a passive investor, you don't need to, it's a term limited partner, which is basically, you're putting your money in and that's it. You might think, well, limited must be bad. And so in this case, it's not, because unlimited is exactly what you said. It's limited liability. You're not liable for anything. You're just putting the money in, and the general partners are the ones that are liable. And as a passive investor, you're not calling the shots, which is great because that limits your liability. And it's a great benefit. I talk to many investors that are always concerned about that. And I tell them, look, you're in this role, you don't have to be worried about that kind of exposure.
Yeah, exactly. And, I know you're a bit of a horse race guy, and, there's a saying in this business, and it's that you're really betting on the jockey, right? Not the horse. So you want the horse and you want the deal itself to make sense. But ultimately, as you mentioned, the operators are really the people that are going to be, seeing this from concept to reality, and they're going to be instrumental in making sure that the deal does what you're hoping to do. They execute on the plan. So good stuff.
Yeah, that's exactly right. And I think you've got a really neat background, Keith, in that you've done, quite a bit in real estate over the years. And it's been fun to kind of watch you and what you've been up to. And not many people have the experience that you do. So it's pretty cool that, that's something that you can use as an asset to be able to bring to a project and hopefully make it work even better.
Yeah, thanks, Dan. You mentioned something in talking about the benefits of investing, and I like the way that you put it, Dan. You said, they invest and then they ride, they take the ride along with you, right? As the operator. And, as far as that ride goes, let's maybe start with the year one stuff. The cost segregation and the tax benefits. Talk a little bit about, an investment in one of your deals. Are you typically with accredited investors only? Is that how you've been operating?
We haven't up to now. Our investments are ones where non-accredited investors can take part in as well.
Okay.
There's a limit. It's up to 35 non-accredited investors. The rest have to be accredited, which really means, $1 million net worth or higher, or $200,000 a year of income as a single person, or $300,000 as a couple. That's basically the definition of accredited. And if you meet that, then great. And if you don't, you can still take part in the deals that I'm a part of. It's just there's some different SEC rules that we need to follow. But one of the things that I like to just verify with people is kind of their situation in terms of net worth, and I don't want this to be a big part of their net worth because frankly, I think that's too risky. Because I have a lot of confidence in the projects that we do, and it's going to work out well. But we're somebody that has limited amount of money to begin with, to put a large chunk of that into one potential property is probably, in my opinion, not the right move. Maybe putting smaller amounts in different properties and spreading, just thinking through that. And so with non-accredited investors, I always have that conversation to find out if they're really a good fit for the project. And if I feel like there's some unnecessary risk, I'll bring it up. But
yeah, I think that's wise, Dan. Especially with non-accredited investors, it ultimately also can mean a rocky relationship with you as the investor offering or GP on the deal. Is just, if that's the majority of their nest egg, they're going to be watching and following that along the way. And certainly, whether they're watching it or not, you're going to be a good steward of their money. But I think it's important to have that conversation, in advance. So, as far as an initial investment, though, you typically, are you doing 50,000 as a minimum, or 100,000 as a minimum?
Yeah, most of the minimums that we have are 50,000 or 75,000, one or the other.
Okay.
And that's how you can get started. And I tell people, look, $50,000, you can't buy a house for that today. I mean, you really can't. So it's, but it's still significant enough money that you can put into a project and get the same benefits you would get from having your own property in terms of the appreciation, the cash flow gains, all that after, say, 5 or 6 years, you come out, way ahead with that investment. It's just, I think it's a great model, especially in some parts of the country, like in Central Texas, maybe in some of the cities there. Right. It's very expensive to buy real estate. And so, a $50,000 or $75,000 investment is, I think, pretty doable for a lot of people.
Yeah, here in San Antonio, we've got about a $320,000 average sales price on a single family. And so if you look and think, well, maybe I'll do this on my own, usually with an investment property, you're going to have to put 20% down, right? So if you're looking at a $300,000, you're already in excess of $60,000 initial investment. And that's for getting in, going back to the one cylinder. I like to refer to it as cylinders, but one cylinder, one rental, one tenant. Something goes wrong on that you lose the tenant, they stop paying, they lose their job, whatever it may be, and all of a sudden you're offline, and you've had to put in 60 initially, versus being able to invest in an $18 million project, where yes, you got 50,000 of the initial down payment, but you get some major benefits. Talk a little bit, if you could, maybe on that cost segregation and the tax benefit. So if somebody invests maybe 50 grand, what type of a depreciation can they take year one if you do cost segregation?
Yeah, that's a great question, Keith, because one of the big benefits of real estate investing is the tax benefits. It's one of those things that you just can't get through stocks or Bitcoin or anything like that. And I really talk about this a lot because this separates it from these other types of investments. You look at a property, the way it typically works is you buy it, you buy, say, the $18 million property that I just mentioned. You subtract the value of the land because you can't depreciate land, and whatever's left there, you divide it out by 27 and a half years or 39 years if it's a commercial property, and then that's basically your depreciation year for year. What we're able to do with what you said, a cost segregation study, is really where you hire a company of engineers that come in and they analyze your property, and they tell you, well, you know what, these curtains, for example, can be depreciated much faster because the IRS doesn't believe they're going to last 27 and a half years or 39 years. They're going to last much shorter. So the IRS allows you to depreciate things much faster that they believe won't last as long, which is a great thing, because once you do that study, then all of a sudden, a lot of depreciation that is spread evenly over that time is now front-loaded. And so you get more of it up front at the very beginning, which is fantastic. And now, the way last year and this year and next year, we have this thing called bonus depreciation, where you can actually accelerate all that depreciation that you had accelerated before all the way to year one. And so it's incredible. Now, this year, it's 80% of that depreciation that is accelerated can be brought to year one. Next year will be 60%, and et cetera. It's going to taper off over the next few years, but that's still a huge benefit. And so what that really means is you're carrying these, passive losses. They're losses according to the IRS, but you're not losing money. You're making money on the property, but you're able to apply these losses to the income you make to be able to basically pay zero in taxes, which is incredible. Like you cannot do that with stocks or with anything else of that category. Now, at the end of the property, when the property sells, then there's something called depreciation recapture, and that's something that there are strategies to work around as well, so you can continue to not have to pay that tax in different ways that are more advanced tax strategies. But these are all things that the person you work with can kind of help you understand a little better. And it's a big difference when you can continue to grow that principal and grow that investment untaxed. It's a huge difference over years. So it's a huge benefit.
Yeah, it is. And even just looking long term, not just at that individual investment, you can apply that same strategy when you exit a property to maybe offset the capital gains that you would have received. Obviously, we 1031 exchange it. All those are various strategies, but yeah, a lot of people just don't realize the true tax benefit. And I know you and I both had an opportunity to do that on our short-term rentals here this past year. And I haven't seen the results yet, at least as of the date of this recording. I haven't received what my CPA has done with it, but I know you have, and it was definitely a positive. So that's great.
Yeah, I mean, that's a great It's a great point. I can talk about that too. Another strategy that I've been following in real estate has been the short-term rental strategy. And that I just bought my first short-term rental, I want to say maybe 6 months ago. And that's been a really incredible experience for me because it's a brand new way of looking at real estate. I almost don't call it real estate. I call it's a hospitality business, really.
For sure.
It's not something where you just buy and you set and you forget and that's it. You have to actively be on top of it and manage it. And luckily, there's a lot of tools now that let you do that, pretty seamlessly. So I'm able to do that without a whole lot of effort. But setting it up was not easy. That was definitely a challenge. But I did a cost segregation study, like we just talked about, for that home. You can do that for homes even. And it turns out that I took out chunk of my investments to pay for that home and all the furnishings and everything. And I had a big capital gain that I had to pay because it was all in stocks. I did the cost segregation study and now that tax is gone. I don't have to pay it now. And because of the big slug of depreciation that I got from that property basically took care of that. And that's amazing. I mean, that's incredible. Tens of thousands of dollars that I saved by doing that. And it's just a strategy that most people don't know about. And so, it's readily available to anybody.
Yeah. Yeah. It's been around for quite some time. And, I did my first one this year. I've been doing real estate for years and years. And I wish I would have applied it. I kicked myself because I look back at various properties that I could have gotten some amazing depreciation on and just didn't take advantage of it. Just, that's why we have this podcast, right? To be able to share those ideas and really to be able to interact with a lot of the folks. Our audience is Dan is most of them W-2 professionals, a lot of them high paid W-2 professionals, but there's so many things out there that a lot of folks don't know about. And that's certainly one of those. What about, is there any kind of cash flow? Obviously rents come in, I know on single family, small multifamily, that's how I always evaluate my investment. How much am I going to cash flow? So what type of cash flow can somebody expect if they invest in a multifamily deal?
Yeah, it really depends, because it depends on the business plan of the project. So to give you an example, I told you that a lot of the work that I do is mostly with value add properties, typically Class C, Class B minus, which is not in the super expensive area, but just kind of working class area, solid, working class area. And the value add approach is basically where you spend a lot of money up front renovating and all that. So in our deals, our cash flow is pretty light the first year or two, as we spend a lot of that money to reinvest it in the property to get the value up. But as years go on, 2, 3, 4, then that's really when you start to see the cash flows increase. And then at the end is when you get the big payout that includes all that you would have earned over that entire time. And so I tend to use a preferred return approach. I think that's fair for partners to be in this. So which means is for example, I think all of mine have so far been an 8% preferred return, which means the first 8% of the cash flow that comes out of that property goes directly to the limited partners, and the general partners get none of that. And only until after that's met, then can general partners partake in that. So I think that's fair for what the limited partner is doing. And what I love about preferred returns too is that it's cumulative. So if say the first year, I mentioned just now a minute ago that the first year or two cash flow is kind of light. If we don't hit 8% the first year or two, that's going to tack on to the next year. So it's cumulative, and by the end of the project, you hit that. So it's a different approach. Some multifamily properties and investments are, say, for example, Class A properties where they're top of the line, the nicest neighborhood in town, probably very expensive properties, very high rents. A lot of those typically do tend to cash flow more regularly from day one, but there isn't as big of an upside because there isn't a whole lot you can do to make it a property that's worth even more. So there's pros and cons to each approach. I tend to like the value add approach better, just because at the end of the day, the income is higher at the end of the day. But if you look at it, quarter to quarter or year to year, you might think at first, you're like, oh, wow, well, I'm not getting a whole lot of money just yet. But that pays off at the end when you go ahead and sell it. So it really depends on the type of strategy that's being played out.
Yeah, it makes total sense. And just being able to see some of it coming in is nice. But what about, and I realize that any deal is going to be different. And, you're obviously going to underwrite it and determine about what the hold period is going to be and about what kind of a multiplier an investor should expect at the end. But on the ones that you currently are invested in, or, you don't have to go through all of them, but can you give us an example of, somebody invests $50K today, how long can they expect that $50,000 will be invested in the property? And then maybe talk a little bit as well about, what the goal is at the either refinance or sell. And you can talk to us about maybe your strategy on that as well.
Yeah.
How do you get your investors' initial investment out of the money, out of the deal, and kind of what kind of returns they can expect?
Yeah, it's a great question. It's a very common question that I get. Typically, say a $50,000 investment in one of the investments that I've been a part of so far, the returns are fairly similar for these projects I've been working on. So it's about 2x multiple over 5 or 6 years or so. So you put $50,000 in now. We would hope that after that you would get $100,000 after 5 or 6 years. I say I would hope because there's no guarantees. This is an investment just like anything else, and there's always risks to take into account. But with the team that I'm a part of, and very experienced team, much more experienced than I've been for the last few years, I'm very confident that I feel that we're going to be able to hit those pretty well. But I always like to mention that there's really never a guarantee. There's never, you never really know. That's why betting on the jockey is so important, because the jockey is really the one that's going to be able to bring the experience and make sure that it happens the way it's supposed to happen. But that's sort of what the return profile looks like. Then if you think, $50,000 now, in 5 or 6 years, it's 100, another 5 or 6 years is 200. After 20 years or so, you're up to, you go 50 to 100, 100 to 200, 200 to 400. Your 50 grand turned into 400 after 20 years is, without doing zero work, is pretty impressive. And that's, you'd be hard pressed to say that the stock market can do that for you. The stock market, I like the stock market. I have part of my investments are in the stock market. I think it's a good diversification. But I'm trying to put all the money that I can into real estate, because I just see it's a lot more predictable. And the stock market can go up or down at any time, and it's really, you have no control over it. So, to me, it feels a bit like gambling in that, eventually hopefully the stock market does well, but at the moment you need the money to pull out, you have no idea where the market's going to be. And if you look at the way the market is right now, it's not doing great. And in a year it might be doing great, and the next year not doing great. And it's just, it just seems like it's not very predictable, and just not something that I think I really want to be paying too much attention to in terms of my finances.
Yeah. Well, and I think you got to take kind of that same approach, whether it be stocks, whether it be a multifamily investment that you're a limited partner on. It's kind of a buy in and then just let it do its thing, right? If you're looking at it too much, especially in this market, it's going to make you crazy, just with the ups and downs of the news and everything else. But the other thing I like a little bit more about multifamily, and I'm diversified. I certainly have a 401k, and I know you do as well. And well-rounded. I think all of them play a role. They're all pieces of the puzzle. But real estate's tangible. It's one of the few things that you can touch. A company can go out of business, and you can literally go from whatever the stock value is today down to zero. Real estate's not going to do that. It's not going to go to zero. It's a tangible asset, provided you got proper insurance and everything on it. You're going to be in good shape, and it's going to still be something of value. And historically has always continued to go up. So
yeah, you're absolutely right, Keith. I mean, that's a great point. It is a tangible asset. You can't touch Bitcoin. You can't really touch stocks. It's not something that could potentially go to zero. I mean, look what happened to Bitcoin not so long ago, have decreased its value as much as it did. You just never know. And with this, it's a solid asset that people need a place to live. There's no ifs, ands, or buts about it. So multifamily investments, I think, are great investments because we need to have that for this country to survive, to have people have, lives and jobs. You need a place to live. And it's really important, which is why the government provides these things like tax benefits and all that to encourage people to invest in housing for Americans, which is great.
All right. Sounds good. And I know we're running a little bit long here on time. So I've just got a couple more questions for you, Dan.
Yeah.
Number one, where can people find out more about you, what you have going on from an investment standpoint, if somebody wants to invest with you?
Yeah. So I have a PDF that I've created. It's a passive investing guide for immigrant professionals. I mentioned that, I'm an immigrant myself, my family is, and I've really focused a lot of my efforts on that audience, but really it applies to anybody. It can be found at immigrantinvestorclub.com, all one word, immigrantinvestorclub.com. And there you can fill out the form and download the PDF. And it's a way of introducing yourself to passive investments for my audience.
Perfect. All right. Yeah, and we'll put that information in the show notes. How about you obviously had a heck of a journey going from zero to 609 units in just a year and a half. Any advice that you'd give a new investor as they're getting started?
Yeah, when I look back at what really made the difference for me was, yes, reading books is great. Yes, listening to podcasts is great. But what really made a difference for me is being connected to other active real estate investors that were successful, because that really opened my eyes to a lot of things that I just didn't really know about. And yes, you learn a lot through podcasts and such, and you hear some great stories. But when you start to interact with people that are in the space, you really do pick up things that you just won't otherwise. So for me, if I were, say somebody, a professional looking to get into real estate passively, I would definitely, listen to podcasts, read some books, but talk to an individual that is active in it. And Keith is a great individual to do that with. So he or I can certainly talk to what it's like to be successful in real estate investing. And to me, that's where the theory turns into actual action. And that is I think for me, a game changer in my past. And I think it could be for a passive investor too.
Yeah, it makes total sense. That's, I think, great recommendation. What, let's see, how about any book recommendations for the audience?
Oh, geez. Gosh, there's a bunch of books that I've been going through right now. One that I just finished reading that I really like. It's not real estate necessarily, but
yeah.
It's I think it's called The Almanac of Naval Ravikant. He's a Silicon Valley investor that wrote this book on his thoughts about life and all that, and really found it super entertaining and very. I just like his point of view on the world, and so I really enjoyed that book most recently. But I always tell people that are looking into getting into real estate for the first time, it's no better place to start than the Rich Dad Poor Dad book by Robert Kiyosaki. That really gives you a foundation as to why real estate is such a great investment to look into. and gets you started on that journey. But I just that one, the Almanac, is one that I found really entertaining. That I just finished. So
yeah, had not heard of that one, so I'll have to check it out. Well, Dan, I've enjoyed getting to know you over the last couple years, and I don't know when exactly this will air, but you may be a married man at that particular moment in time, right? So excited for
that's right.
You
that's
and
right.
Sarah.
We're getting married here in a few weeks. So
Yep, that's fantastic. Well, Dan, I really enjoyed this, and I appreciate you taking the time to be on the show, and we will let you go.
Yeah, thanks, Keith, and congratulations again on the podcast, and looking forward to seeing future episodes.
Absolutely. All right, thanks, Dan.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.